One thing I know about business owners, you got to have a short-term memory. If you remembered everything you ever did, you wouldn't get out of bed sometimes. I lost several of my clients, very pillars of our community I was in, just were auctioned off because banks do what banks do in those situations. I created an incentive for Congress to create this tax code to begin with. There's unaffiliated claims you're going to have to pay that aren't your own. This is not a risk-free adventure.
Hello, my name is Jason Reichl, and you're listening to Risk Management Brick by Brick. I'm fascinated with people who are helping build and maintain the physical world around us. On each episode of this podcast, we'll dive in with a risk manager, speak to them about how technology plays a role in this process.
Welcome to Brick by Brick. Today I have Van Carlson as my guest. He's the CEO of 831B Admin. Nice to have you, Van. We were talking before the show. I'm excited to sort of dive into the world of non-transferable risk. So thank you very much for being here. I'm excited to talk.
Yeah, thanks, Jason. I look forward to the conversation we're going to have. So
great.
Always good to be talking to other risk managers. So
yeah, risk managers. One thing I like to start off with, because nobody ever says, hey, I want to be a risk manager when I grow up. How did you end up in this role, and what's that path look like?
I had to make a choice coming out of college. I was working for FedEx at the time. And I saw myself traveling a lot and working in the world of corporate America. And honestly, if I was willing to work 70 hours, I should go work for myself. And I actually started a property and casualty agency in the town known as Meridian, Idaho. I'm headquartered out of Idaho here in Boise, and that hasn't changed. So, almost 30 years later, I'm still doing it, and I do enjoy it. And I love working with business owners that take risk every day. So.
Yeah, I like to talk about, one of the things I think we're going to be diving into that you're an expert on is around the idea of defining your risk appetite and then monitoring that, right? And when we talk about these kind of risks, it's really important that we kind of get into that. So my first question is, just because not everyone is familiar with 831Bs, like, what is the basics of it? Can you explain the primary purpose for small businesses, and how do risk managers know if they should be thinking about this?
Yeah. So there's an 831A and 831B found in the federal tax code, and it's just the way insurance companies get taxed at the federal level. The nice thing about the B, any underwriting profit within the insurance company that year, as long as it's less than $2.85 million per year going into it for premium, stays tax deferred. And what it's designed to do is build those small to middle market property casualty insurance companies up to where they can take on more risk, because that's what insurance companies live and breathe to do. Is they build surplus. They go out and look for more risk to take on. And so by taking that tax deferral, so we bring it down to those small to middle market business owners. I think a lot of your listeners are probably used to macro captives, which are just replacing their traditional insurances. What we're working with is the small to middle market business owners that can't transfer risk, like you brought up earlier.
What are some of the typical risks that fall under this that you see businesses applying to?
I would say complete business interruption, whether it's indirect or direct. Those are things that we're seeing more and more. The complications. COVID-19 was a good example of that, where PPP had to be brought in. Those government programs had to be in because business interruption was not going to cover. Traditional insurance was not going to cover those types of risk. And then you get to continue with supply chain risk, brand protection, dispute resolution. I mean, the code came out in 1986. The 831B was introduced in the 86 Tax Reform Act. It's been around for 40 years. Big companies adopted very quickly to this program. We're trying to bring it out to the small to middle market business owners, what I think have more risk than, let's say, a big publicly traded company does today.
Right. That makes total sense to me. They are taking on lots of risks in order to keep business up. Just because I'm curious, does tariffs and things like this, where maybe your operational plan, if you're working on very tight margins, might not make sense in the future? Are you thinking about that? Is that risk that you're advising your customers against?
Yeah, we would consider that political risk. Regulatory risk. I mean, those are real risks. Those are unforeseen situations. Well, tariffs are a great example of that, right? You sold your price at X and now you got to buy it at Y. That's a hit to you. We saw that a lot during COVID, obviously in supply chain risk, where we had business owners that were locked into big contracts. They had to deliver one way or the other. And, in order to deliver, they either erode their margin or just take a loss, and in order to keep the business going. I mean, a lot of this, in business at certain cycles, we get caught up in that. And that's really what we're trying to do, is cushion those situations where, and it's like anything else, Jason. I tell clients all the time, if you're doing really well, to park a little bit off the side in an 831B is not only good risk management, it's just simply good business.
Right. That makes total sense. So I guess let's talk about the financial benefits of this in terms of tax deferral. If I'm a risk manager and I want to go to my CFO and pitch something like this, sort of what's the standard way to get started?
Yeah. So first and foremost, we've come out with a new policy called Halo coverage. We kind of feel what's going on in the traditional market, very similar to what's been going on in the 80s. What even spun this code into existence was very similar to what's going on in the 80s, what's going on today in traditional insurance. We feel like you're paying more in premium, but you're getting less in coverage. So we do a full assessment of our clients' policies existing. We're not here to increase or decrease the risk the clients have. We think traditional markets do a pretty decent job, but they also have the role to play. They're gonna bring out more exclusions. They're gonna bring out more limitations to the policy. All of those things they have to do to manage their risk. And so what we do is we do a full-on assessment of their policies first and foremost, and we really start to look at first off, listen to the client, what's going on with them, and then look at their industry. So we kind of know what's going on in their industry. We're the largest manager of these plans in the country. We've been doing this the longest, since 2008. And that's one of those things that we've gotten really good at. I think as risk managers, you start to see holes and you start to see issues out there for business owners. And we try to plug in. And what the Halo does is kind of similar to an umbrella, but it's only for first dollar loss, exclusions, or limitations on the policies when it comes to business interruptions, all the other things other than liability. An umbrella sits over for liability coverages. Halo sits over for property and those types of losses. So one of the things that we're dealing with right now, based on the current market we're in, we're looking at exclusions and all those other things that happened in the past and listening to our client. And then the Halo sits over and above that. So any first dollar loss, co-insurances, we're getting a lot of co-insurances right now on properties. We're not getting replacement like we did several years ago. We're getting a lot of actual cash value minus depreciation on policies, on risk specifically after a certain age. And the insured at that point is just taking that on in-house. And now how do you want to fund for that? Right. Pre-tax or after tax. And if you want to use pre-tax, then we're the company for you. But that's really the first step. But it's looking at the risk, doing a full assessment of their risk, and then enter the traditional insurance. And then we look at the enterprise risk management of the business as well, and look at, hey, are you worried about supply chain and risk? Are you worried about brand protection today? Dispute resolution? Are your cyber policy strong enough? How are we looking at employer liability practices? I mean, there's a lot of clients that, because they have a business operating policies, the BOP, oh, I got coverage for all that. But when you really dive into that policy, the sublimits in those things are so low.
Right. They don't cover any kind of incidents actually really happening at the degree that you should be concerned about it.
No, absolutely.
Absolutely. Yeah, fascinating to me. I love all of these alternative ways to outside of mitigation to address risk. I feel like in the risk management world, so much risk managers at organizations, especially larger ones, have come from insurance that they make that their primary mode. I've been talking to a lot more accountant-based backgrounds, tax background risk managers who are bringing whole new sort of ideas and approaches to risk management around the idea of mitigating this risk appetite not covered by transfer. And I think as insurance is harder for your vendors to get, more and more risk is going to be pushed to the business that's actually signing the work.
I couldn't agree more. And we're seeing it. I mean, one of the things insurance companies, I think, like you said, I think for the most part, they do a good job. They really do. It's just, they have the role to play. It's no different than banks. Loans start to mean things when the economy takes a hit, right? I mean, the bank covenants and everything else. Well, I think insurance companies are doing the same thing right now. They're having a hard time making money. They know the consumer can only pay for so much. And if they can put more exclusions in the policy, they're essentially if you're paying the same amount of premium you did last year for the same policy, but the policy has 5 more exclusions in it, or there's 5 more limitations, they took a rate increase on you. It just doesn't look like it, right?
Right. Exactly.
And the consumer can only bear so much of this. But to your point, the burden will continue to fall back on the insured, unfortunately. And I do think every year business owners find themselves that, I look back at mold when that first was going on, I don't know, 10 years ago or more. It's probably more than that now. I look back at it, but that was not even mold. And then all of a sudden people started mold. All of a sudden started creating cancer. Well, what did the insurance companies come out and do? They just simply went out and excluded all that, right? I mean, that's just
right. Absolutely.
it was a black hole they did not want to go down. And unfortunately, some of these coverages, when I look at from 86, almost 40 years ago, right, this code came out. And back then it was GL getting cancellation and crop insurance was going away. Private sector was getting out of it. Now, obviously, it's backed by the federal government. But back then, that wasn't happening. So that created the incentive for Congress to create this tax code to begin with.
Yeah.
But 40 years later, you just look at the complexity of risk with business owners today. Who would have thought about cyber? Brand protection, that wasn't even a thing. Supply chain
active
risk,
shooters, all this kind of stuff that are not usually covered.
And we know the insurance company's not going to be in a hurry to increase their appetite for that either, right? I mean, very hard to quantify. Honestly, I mean, look at cyber. About 60% of cyber claims people don't submit them. They're worried, they're not submitted to their insurance carrier because they're hoping to just slide by. I mean, and when insurance companies have to worry about that, that's a lot of data points that aren't really being accounted for in actuarials, right? I mean, so are they pricing it right or not?
This plan, the 831 sounds awesome, but when I, did some research when we booked you and it's like, okay, how is this looked at in the market? There's some, negative aspects of it. So maybe could you talk about some of the misconceptions of the 831B and how it works you guys come across every day just to kind of, if people have an idea of this, that they can sort of get the reality?
No, I thank you for the question. I would tell you this. The tax code was hijacked. It was hijacked for estate tax planning. It was, I tell business owners all the time, is your risk manager promoting this or your attorney or CPA promoting it to you? I think the CPAs and attorneys know really good, no tax code. They don't know anything about risk management. They've never sat down and try to get to an insurance policy, not alone, and so I think that's first and foremost. And I tell business owners all the time, if you're doing this for the motivation of tax purposes only, then we're probably not the manager for you. Honestly, we're going to talk about risk. You're going to participate in pools. We are going to pool you with risk. There's unaffiliated claims you're going to have to pay that aren't your own. So this is not a risk-free adventure. Just because you don't have your own claims in your operating company doesn't mean we still have to create a pool in the back room. And those are the things that business owners need to do their due diligence on and really understand the risk they're doing this program. And I wouldn't say so much an IRS risk today, even though on the outset, it would appear that way. If you're not pooling, and this is really where I would say really clever attorneys have gotten together and made it appear like a pooling, and they got caught in it. And if any of the cases you were to read that the IRS talks about, it's really because it was done for estate tax planning, and it was a mirage when it came to pooling. And we don't mirage pools. We have real pools out there. We call them risk co-ops. You're going to participate in other people's claims. We do it in a way that we think manages the risk very well. But I think at the end of the day, I think any business owner needs to understand that you can't have a single insured and call yourself an insurance company. There has to be a distribution of risk. You have to show the law of large numbers. And if you don't show that, then you can't elect under the 831B because technically you're not an insurance company. Our core competency, Jason, quite honestly, is managing insurance companies. We're not here to complicate the business owners' lives. It's what we do every day. And we're just here to educate the client, bring them up to speed. We don't, and honestly, we're here to be a complement, not to complicate what they do every day. They got a business to run.
I like that. Yeah, absolutely. So this is nothing that any of these businesses started off wanting to even deal with. This is not why they started the business. This is kind of the biggest thing I find in risk management that is so interesting, is that every business has it, yet no business is really built from the ground up with the idea of this. I mean, your business is obviously risk, but so few businesses actually understand risk in a holistic way. We just hope for the best. I've owned multiple businesses myself, and I have to say, in 2020, I owned, as a hobby, I owned a board game company. And when all the prices in China went up on everything, it was hard to get products here. It basically killed the entire company. I couldn't make runs to Walmart or Target successfully. So there's just all these downstream effects that you're not even hyper aware of when you're trying to accomplish these things. I think alternative programs like this make a lot of sense for businesses who have a lot of exposed risk.
Well, we're talking entrepreneurs, right? One thing I know about business owners, you got to have a short-term memory. If you remembered everything you ever did, you wouldn't get out of bed sometimes, right? So you got that. And then you got to be optimistic as hell. I mean, thinking about risk is negative. That's the perception of this thing. But I will tell you that, once you elevate to your company, achieve to the level of your company where you are worrying about risk, I mean, you're winning, honestly. I mean, you're doing well. And I think, at some point we all have to doubling down and just for the sake of growth and all the things that we know how we should grow our companies. At the same time, I think sitting back and looking at the risk to do so, it's like everything else. It's a risk reward factor. And I think as you mature, the risk reward has to be evaluated at every turn in your business.
Yes, absolutely. Maybe just, to make this more real for people who are listening, maybe we can talk about, a success story where the A31B plan significantly impacted a company you're working with, as much as you can talk about specific stories.
We actually have some case studies on our website. We're actually on 831b.com. That's where our website houses. We have some great case studies. We've got experiences now with ag business has become a big part of our book of business. I mean, it wasn't that way about 18 months ago, honestly. But what we see going on in the ag business today is huge. I mean, those guys are getting hit with single peril exclusions where hell's now being so, and the price of costs are going up, their ACV on everything else. So they have the appetite to self-insure risk more and more because this is the ag business. These guys they're not afraid of taking their own risk. Right. So, but on specific cases, I've seen it where, supply chain risk, kind of like what you brought up. I mean, we had this incident where there's a big denim provider around the country for major denim. It was a major denim supplier and for box stores on certain products that they were name branding on their own products. And he had a really strong contract. If he didn't deliver in time, he was going to lose the contract. Plus he actually had to come to the table with their money for his. Yeah. Yeah. And so he ended up paying $400,000 to air freight the denim versus putting it in a shipping container to bring it across the ocean. Right. Yep. And that was a big hit to him. He basically was a loss. Leading up to our program, he had been funding our program over the years. So he was able to draw on those dollars and not miss a beat in his company where, that's a hit to a lot of companies, those are really unexpected expenses. So that's
especially something in like fabric creation and moving, like the margins in those businesses are not very high at all.
No, very thin. And we're seeing more and more in that. I think more and more businesses are finding themselves on the hamster wheel where, they a lot of volumes got to keep going. I mean, and in order to get their margin, and their margin used to be X and now it's Y and it's a lot smaller, and volume is everything. And the more of that's happening, it doesn't take much for that, a clog in the wheel, right? I mean, it just doesn't. And, and that's really where back in 2008, I was leading into 2008. I had so many clients of mine that were very, very successful. And, one of the things that drove me nuts, what they know is the 172 accelerated depreciation. Buy more stuff for the business and, everything. Then we can, we can take a deduction. Our tax bill's not so much. And I used to love the fourth quarter too. I always tell clients, I tell people that I love the fourth quarter because they'd call up and say, hey man, my CPA says I owe X. I'm going to buy another skid steer and 2 more trucks. Right. And what they did was they took the accelerated depreciation, but then they financed the equipment and they just bet next year was going to have to be better than this year because why? They just took on debt. And that's a form of insanity. That's all they knew. And that's really where I lost several of my clients, very pillars of our community that I was in, just were auctioned off because, banks do what banks do in those situations. And I looked at the financial risk business owners were taking, and I thought there had to be a smarter, better way of doing business. And I happened to be around a gentleman that had 6 or 7 of these plans in this arena already. And I just saw what he could do with it. And that's when I thought, I'm changing my mission here. I'm changing my risk management to the point where I'm trying to bring a holistic approach to what they're doing, not just what the traditional insurance carriers can do, but really all the financial risks business owners take every day to do what they go do. And how do you position dollars more effectively and efficiently to survive the unknown?
Yeah, absolutely. I was talking to another guest a few days ago, and I was talking that we were going to have you on the show and what you do. And one of the things that they were concerned about, and maybe you can put peace of mind here, because, when someone's concerned about is, what about regulatory changes and things? Are there things that because of the administration, the way it is, that you see these things are going to be changed at any time soon? Or what is the outcome of this being a continued program that makes sense, and also expand how it will expand in the next, year to 2 years for people getting onto it?
I mean, we're going to have a record year at this point. Tariffs, I think, again, it's creating a disruption with business owners.
Right.
First time thinking about things that they haven't thought about in the past. So awareness is high. Traditional insurance is doing what they're doing. I would also tell you, it is very trenched, not only in business, like large company industries, like large companies insure themselves all the time. They have their own
Right.
insurance companies, right? I mean,
Yeah.
I mean,
Captives and all
UPS has
sorts
been
of things.
sued by the IRS more than any other big publicly traded company. And they own a ton of insurance companies. UPS does, just for the damage waiver. It's very much entrenched in everyday life. The small middle market business owners and the traditional consumer, they're not aware of this, but it's been going on for a long time, first and foremost. The second thing is on that front is, I think the burden's going to continue. Like we've already kind of addressed this, that the burden's going to continue on the insured. So it's not like self-insured risk is going to go away. It's going to go up, in my opinion, if anything, in the foreseeable future. When you start talking about coastal property, I mean, I can go on about that, and I'm sure you talk about it, and you know about that stuff. It's just, so for me, it's becoming, we think it's going to become a normal business practice, no different than the 401k, honestly. Now, does the IRS like this thing? No. There's some tax benefits to it. Yeah. Has it been abused? Yeah. But so is 401k. Every tax benefit out there has been abused, honestly, right?
Right.
It's what we do as Americans. But at the same time,
you got to kick the tires of the system, right?
Oh yeah. I tell people the Boston Tea Party was a real thing, and it's almost entrenched in our DNA, I swear. But anyway, I say this because I just think it's, and it's not because of the tax incentive. It's simply put, the risk strategies, the risk management, the ability to manage those. And then, hey, if you have the appetite to take on higher deductibles and co-insurances and all that, here's the best way to tell it, Jason. This is like a health savings account for your business. Right. To pay for unexpected expenses. Your insurance is not going to cover it. I can take a deduction now with it as if it happened. And I hope I don't need it. And down the road, hopefully it becomes another retirement bucket for me as a business owner. That's essentially what we're doing here, honestly.
Right. Yeah, it makes total sense because, by creating these risk pools, you're helping them de-risk it, which is something that most risk managers couldn't even do on their own. Sort of running it as a captive-like kind of situation. And then ultimately you put money into this, and if you've been doing it long enough, and because there are now so many more eligible risk types that can fall under this versus just the crop and the kind of initial ones that you had, you're also diversifying the risk, right? Because not every business has the same cybersecurity risk or that has the same X risk. So
foodborne illness is a great one.
Better, and it makes total sense that this would be something that could be opened up to the middle market.
Yeah, absolutely. I look at all sorts of certain industries definitely have their own niche. And I also would tell you this, that, I love working with business owners. It always amazes me how people make money in this country. But the more unique, the more niche, the more unique the product you make. The insurance industry by and large they have pegs, or I should say they have round holes with round pegs. And if you're not in that, they'll still squeeze you into that round hole, whether you like it or not.
And sometimes it's 10 years later before they even develop a round circle for you. So you're just flying kind of blind for a while.
Yeah. And I would tell you that, right. And so the more unique you are, probably the more gaps of coverages you think you do have, because it's not necessarily fitting your needs. It's the insurance industry just classified you that way, right? But you may have some really unique risk that you need coverage for that the insurance carrier is not going to get you there. And you just hope to God it doesn't happen. I mean, that's literally what you're doing, by the way, which is kind of scary, actually.
Very scary. I really appreciate this conversation, man. I want to play a game of Risky or Too Risky and get you out of here. I think I'm going to ask you some stuff about company risk. So let's start there. So you are yourself, or you are consulting with an organization that is thinking about acquiring another company. The financials look good, but they haven't looked at the cultural impact of those employees versus their employees and the way they work. Risky or too risky for you?
Risky, but not too risky.
So do financials tell a lot about corporate culture as well, do you think?
Yes.
Yeah, interesting. Let's go. Expanding business operations into a region known for political instability. A lot of organizations are doing this. They're building in places now. You have organizations that are buying GCs everywhere and becoming like one roofing company, but they don't know anything about the areas now that they're deployed to. So expanding business operations into regions known for political instability, environmental instability, risky or too risky?
Too risky.
Investing heavily in a single technology trend without diversification, risky or too risky for you?
I like technology.
Good.
I was not too risky.
Let's start there. So, the technology that everyone's talking about is AI. How has that played a role in how your team works and how your business works, or not yet?
We're utilizing it through marketing, but the other way we're utilizing is an AI called LegalOn, where we're able to feed in contracts. And we built out a pretty good prompting library to where we can really start to take insurance contracts. We're almost kind of like, it was used for attorneys, LegalOn was.
Yeah, I'm very familiar with their AI system.
Yeah, are you familiar? Yeah, and so now we're kind of using it towards our as we build our prompting library, we're really getting into some of these policies. Insurance policies are hard to read. I mean, they really are.
Very hard.
You got to like have a pot of coffee and keep pinching yourself to stay awake. But with the LegalOn, that's been a huge benefit for us. So and how quick we can do it, how we can summarize them, has been a huge value add for us, honestly.
Yeah, and I know, like, for a lot of people, let's take this for risk manager and the AI. You know your policy, you read it, you agreed to it. I guarantee you the first time you're like, oh shit, is my thing covered in this? You're not going to be able to go back and find that information, right? So having that prompt library built and then be able to go ask it questions in real time, I think it's going to be significant in the way that people understand their insurance policy and the way they interact with
right. And you could do a great summary of it, right? You don't have to, it'll be interesting in the future how, here's your policy, here's how we summarized it, here's the high notes, here's the low notes, here's the good, the bad, and the ugly on it, and hand that along with the policy, I think would be interesting.
Yeah, absolutely. Van, I really enjoyed talking to you. I think that you're doing a very interesting practice here, and I really love when these kind of large enterprise risk management solutions get brought to mid-market, because I really believe that's the heartbeat of the economy, and the stronger we diversify risk there, the healthier our entire economy is. So thank you for doing the good work, man. I appreciate it.
Yeah. Well, Jason, thanks for letting me be on your platform and educating what's available to business owners today, for sure. So appreciate it.
Van, where should they reach out to you if they want to get in touch?
Yeah, 831b.com is a great, and we made that website to be an educator, to educate clients on and do the due diligence. And then, of course, I'm Van at 831b.com. Always happy to take an email. And we work with a lot of risk managers all over the country. And I love working with risk managers, honestly, more than anybody else in the field that we work with. And so I love helping be part of the solution, not always complete solution, but start to be part of the solution for business owners out there that do what they do. So
thank you so much, man. I appreciate your time today.
Yeah.
Bye.
Thank you, Jason. Take care.
Risk Management Brick by Brick is brought to you by TrustLayer. Find out how TrustLayer manages risk so that the people can build the physical world around us. Head over to trustlayer.io, and then make sure to subscribe to Risk Management Brick by Brick on Apple Podcasts, Spotify, or wherever you get your podcasts. On behalf of the TrustLayer team, thank you for listening.